We're back again for another episode on the InvestorKit podcast. And this particular episode, we'll be going into the world of financial planning once again. And in this particular part, it's different to the other financial planning episodes because when I've spoken to other planners in the past or other companies in this space, I've been digging into the specifics of things like self-managed super funds as an example. Now, in this particular case, I've been actually fielding a fair few questions from clients. And after hearing some of these questions, I thought, you know what? Let's get the experts on, those who can actually talk about these things and go deeper. And why is this important to know? Well, yes, I'm a property investor. And yes, I run a buyer's agency called InvestorKit. But at the same time, it's really important to recognize that I carry biases with this asset class because this is not only what I invest in personally and truly believe in, and I'm all in on the research side, but also this is my company, my business that I support clients with. So it's important to remove that bias and speak to professionals in other field who, hey, look, one could say they might be biased in their field. But as listeners to the show or watchers to the show, you deserve to hear it from all, and you deserve it to hear it from others who are in a space that's different that can complement you on your journey. Because at the end of the day, this podcast was set up not for me to go, let's talk property and this is all about me, or let's talk InvestorKit and this is all about InvestorKit. This was set up so you could go on to achieve your goals, be educated, and learn more. And that's what today's episode's about. Now, I'll be joined by Shamsher Singh, the founder or one of the directors at Royale Wealth, and that's Royal with an E. And Shamsher Singh is going to talk about two specific areas. Like I mentioned before, the world of managed funds. So this is like share investing, but in bigger groups rather than an individual company, and the world of insurances and risk management protection strategies, which to be honest is an area that's hit home for me. I've had some news recently of some stuff that I didn't know I had as health issues. And had I not gone up and checked myself out for those issues with regards to, insurances and protection, I wouldn't have known that I actually had those underlying. So you can see this in one of two ways. You can see that as a blessing in disguise. And I went through the process of, being proactive. And then I found out that like that. Or you can say that, hey, this is me having that check and everything's going well, not me personally, but yourself. And it's working out and you're covered and you feel so good that you're covered for your family for matters where it comes to generational wealth, all the work you're putting in to build a portfolio, build assets. You don't want that crumbling down due to unforeseen circumstances. And so this is where this episode goes through what are some of the different insurances, some of the different things to think about when it comes to financial planning and how they help, as well as a little bit about managed funds. Now, if you feel like, Arjun, I'd love to know more about them and go deeper and deeper, please drop me some questions you'd love to hear more about. And that's arjun@investorkit.com.au, ARJUN. So we can go into some of these questions even further and get Shamsher back on the line again for another episode. Shamsher, my friend, welcome on to an episode with us at the InvestorKit podcast. I firstly wanted to say thank you for putting aside some time because I know in your world and the deep and complex client discussions that occur can be full on. But mate, welcome on.
Yep. Thank you, Arjun. Thank you so much for having me today.
Mate, for those that don't know you, my friend, let's talk a little bit about your business and what you do and what your company does, just so they can give them a little bit of more of an understanding about you.
Yep, definitely. By trade, I'm an accountant, and also I'm been doing the financial planning business since 2010. So we self-licensed under the Royale Wealth business name. We're based in Melbourne, running from the three different offices from Melbourne. Team of 7 people in the group. 3 are qualified financial planner who actually go and meet the client to give advice. I'm the key person in the business, so I'm mainly sitting into, you can call me sitting in the room and managing all the compliance and looking at the business growth. And we got Krina, she's a branding manager. She look after all the branding side. And we do have a person who look after all the implementation. Her name is Kayla. So mainly financial planning side, Paul, John, and Courtney, they go out and give the advice to the clients.
Awesome. So you've got that combination of financial planning and accounting. Is that right?
Correct. Yeah. So we do have it's a two different names because of the compliance, and we do have a full suite of services from accounting and financial planning. So from accounting, we do have Ananda, Tom. They are the senior accountant in the practice. They manage all the accounting needs. And then, as I mentioned before, from the financial planning, we do have Courtney, John, and Paul. I own both the businesses, but because of the compliance and making sure the client understand two different teams, they work under two different brands. So that's why we have separate names. One is EH Tax and one is called Royale Wealth.
Awesome. Well, I know we've collaborated on some clients together, and hence I thought it'd be great to catch up because they've had a great, obviously, service from your side as well and your team and helping them get to their goals. Today's episode, we're going to cover off a few things around financial planning and just to make sure people understand where it might be more of a fit to work with one, the type of help that they can get. Because I think still today there remains an education issue in Australia about having that help, knowing who to go to, what they can help you for. So I thought it'd be good to start off with that. But I know before we get into this, it's important to give everyone a little bit of a disclaimer about personal versus general advice. So I might hand over to you to just give that out, just to make sure everyone's aware.
As we all know, this financial planning industry is heavily compliant industry, and that's why it's good you already actually mentioned to me give this disclaimer. That was my next step. So today's is anything we talking through this air online. Sorry, it's there is no personal advice involved. It's just more generic to our any listener. If someone needs more into because everyone got a different situation, so we can't throw all the balls into one court. So if someone needs a personal advice, they need to contact us, and that's how we can go into the personal advice.
Shamsher, could you tell me a little bit about managed funds? Like, what are they in terms of managing that portfolio of shares with a financial planner?
Managed funds is like run by the fund managers. So basically, I think most of the people they are with the industry funds. They manage funds is the money invested by the fund managers to the shares. The ETF or bonds depend. So if you are industry funds, you have no control technically because there is the fund managers. They from the industry fund group and they managing on your behalf. And then there is something between SMSF and industry fund called a retail fund. So that's where you can actually invest the money through the financial planner directly, and you have some. It's like you still have no control, but you can still get educated by the financial planner where your money is invested through the fund managers because you need someone who actually know the job, and the fund manager they are very qualified and experienced in the fund management side, and they select the right funds for you where to invest. And that's how you connect with the financial planner, and financial planner helps you to go through the right channel to invest your money. But it's like still giving you the good option. Do you on the base of your risk profile? That's the main question because people they don't understand how much risk they can take. And industry funds they don't send you the forms to fill to check how much risk you want to take with your money because it's your money at the end of the day. So they just invest on the base of the group. But when you hire a financial planner, the financial planner actually works for you. And the financial planner take your risk questionnaire and explain the risk you're taking if you invest this money and how it's going to benefit to you if you invest into the right managed funds.
That makes sense. So now it's like instead of just it sitting in the fund and you just hoping that they sort everything out for you, you've got that person in between to filter the information to go, hey, this mix of portfolio of assets that you're investing in is better suited to this type of category. And through knowing that person in front of you, their goals, their risk profile, and that relationship with the financial planner, you can then start to advise them in a certain direction that go, this may be more of an option that might suit what you're talking about. And this can start to remove that complexity people have because of how many choices there might be out there. And I can start to understand. So it's definitely not like that, hey, Afterpay is looking really good now. Go chuck in your money into this one and see how it goes. So at least we can bust that myth out there that that's not what financial planners are sitting around and doing. So that's good to know. Mate, I wanted to understand on that mark, like people obviously will have different starting positions and different age in life. So we can't talk about it personally, but in your business, typically, where do you see people going, hey, this makes sense for me to put some money across into this from my personal savings or personal investments? and maybe I feel like I'm now ready for it. Is there a typical amount you see when someone's like, okay, if you're hovering around this amount, it might be a consideration, and maybe don't consider it this early on? And is there a type of goal that customers are looking at where you notice, okay, they're more suited for this rather than say property? And obviously it's general in nature. I just want to understand that thinking of when someone should be considering this versus all these other channels of investing, because there's so many ways to invest, right?
Yep. So basically, I think it's not a fixed rule in our world, because if someone is young and they got good money from the family, and they can always start at the age of 20, 25. Someone, they don't have the money until the age of 50. So as I said, there's no fixed rule. It's all depend on your goals. It depend on mostly young people, when they start their job, and the first goal there is like to buy a property, so they just want to secure themselves for their home. What I have seen through my experience is people, they start thinking about their financial planning or retirement planning or manage funds after the age of 40, because by the age 40 they already had maybe one or two properties secured, they got a family settled, and the kids now going into the high school, or maybe in the primary school. So that's where the people, they start getting serious, and they start thinking about, if they invest now, what they're gonna get when they get the age of 60 or after 60. So it all depends.
Yeah, that makes sense. So that age group, do you find like they are also kind of diversifying? Is that commonly a move because they've got those couple of properties and diversity starts to come to a piece? Because I can imagine it might be like a little bit more comfortable for certain people when there isn't that debt attached to it, the repayments, the costs. This is more just their money they're regularly putting away into this fund, or lump sums they're putting it away, and they're letting it do its thing. Is that kind of the personality that you see that often wants to make that decision?
Correct. The first thing is, we, at the financial planning side, we always look for clients to diversify it, because you don't want to be put all the eggs into one basket. You don't want to be, something goes wrong. Let's say you're putting all the money into one investment, or all money going into the one property, and something goes wrong, and then you actually stuck. So to diversify the portfolio, it's always to minimize the risk. We, as a financial planning side, we do educate the client what to do. Some funds may be performing well, some funds may be not performing well, but average, you want to be still want to sit in the win-win side. You don't want to be lose. That's the goal.
And do you find from like a financial position, if you put too less of an amount, it can get chewed up in fees and things or other things like that? And do you find like there's a golden rule where it needs to be upwards of 100K for this to make sense, or upwards of 50K for it to make sense, or bigger numbers? It's just something I think like many people might not be aware of as well.
Look, I think the startup is always 100 or above, because if you hire a financial planner, of course someone is going to work for you. There would be a fees to pay. Yeah, if you got a very small amount, let's say 20 or 30K, probably it's not worth to pay the fees or get someone to look after your fund. It's still people, they love to keep with industry funds, but when you hit to, I think, the number of 100 or above, more you have, it's always good for you. But you can do the comparison, because industry funds, when they do the work for you, they still charge their admin fees. They might not expensive, but still there is a cost involved. But when you hit to the numbers and you feel it's a time for you to take advice from someone who actually professionally can research on your fund and give you the proper advice, I think the start point should be around 100 or above.
That's really helpful. Now, that's obviously a growing wealth aspect of things, but in the world of financial planning, there's also the element of protecting your wealth. And protecting your wealth is a big piece, like things like covering for insurances in the worst case event, for income and other factors. Firstly, could you give a glimpse of what type of protection exists in this world, and what do they all do for people, like why they should consider it? Because I noticed that's a part of financial planning as well, right? It's gaining wealth, planning for it, but then also protecting it.
Yeah. From the risk side, when we talk about, I believe everyone, we need a protections when we work. Even if you not earning a big amount, still you need a protection for yourself. Like if you're working today full time, you're making about, let's say, 4 grand a month, which coming to your family. And if something goes to you on the road, you're not at an employer's site, you're not at home, you're somewhere outside. What happens if employer says you got an accident and you can't come back to work for another 6 months, and your annual leave is only for maybe 4 weeks, 6 weeks? So from the risk side, you're definitely looking to cover yourself from the income protections, at least, and the life insurance. If something goes to you and you don't want to leave your family on the road, if you've got a young family and your wife, yeah, so you definitely want to protect yourself. If you passed away, and then of course you want to give the money to your family so they can pay off the mortgage, and if there's a young kids, they can have the money for the schooling. So income protection is one of the type. Then you got a risk insurance, TPD, trauma. So these are the four main protections you can call, people they love to have if they can afford.
Yeah, and so with these four, you've got income from the perspective of like your day to day, your wages coming through. You've got TPD, is that total permanent disability? Like if someone has a big disability event, but they're still alive, it's just that they cannot function maybe the same way. Then you have trauma. Could you explain trauma or critical, what that means?
Trauma is mainly like the disease which is like it's not like permanent disabled yet, like stroke. Maybe you off from work for 3 months or 2 months or 6 months. Yeah. So, and you need a lump sum money to pay for the bills, because it's not everything covered under the Medicare. There are some disease which, if you fall under that disease, and of course you have to go to the treatment, then you can claim that lump sum from the insurance provider to pay for your, it could be pay for your mortgage, could be pay for your living expense, could be pay for your medical expense. So trauma is like it's not like you're injured, you're still alive, you're not permanent disabled. So, but there is a life-threatening disease, means you have to be go for a operations or surgery or treatment, and you need that lump sum money, to pay off your
Mm,
expense.
that's tough. That's tough times. If someone's going through that and imagining if they don't have the financial position, the income, these sorts of things can help tremendously. You've also got life insurance, which is that fourth one, right, in the passing event. I often find insurance is something that people like take into account at the bottom of the list. It's surprising, right? Because it's so rare that these things can happen. Yes, but they happen. And like all it takes you to do, like I remember this, it was a scary thought I had, but I literally pulled up one of those world clocks and they show the population of the world and then like the deaths, the births, and all these things just in this Google tab that anyone can search up. And it was scary just seeing how many deaths happen every second around the world like that. It just shows that we honestly have this happening around us. They might not happen immediately in front of us and all the time, but just when it comes to like building wealth and investing in property is what we do, and obviously helping others holistically is what you do. You can't like under appreciate that protection piece, because the the whole point many of us are building wealth is not just for our goals but also for our generational wealth perspectives. Many people who are investing, they have families or they want to have a family. I can't imagine, and like no matter how hard I've worked, if something happens to me, like I just can't imagine my family taking on the risk or the responsibilities of a 17 property portfolio and different businesses and things like that. I just imagine them going, okay, it's too tough. No, sorry, just see you later to everything. And then what? Like, what have you put in all that work for? You want them to be in a better position, but they're not. This is something I just wanted to make sure I stick home as a talking point, because I truly think that has to be a consideration. Now, Shamsher, for you and your clients, when you see it as a consideration, do you think of it as a talking point, like when they come in and they have mortgages? Do you think that people should consider this even before mortgages? When do you feel like is a consideration piece that's quite high on the list?
Look, I'll probably, when we have the meeting with the clients, even if they're looking to do the mortgages, we always explain them, to have the insurances now instead of like wait until the mortgages you go into. What happen if you're not settled the deal? Like if you're not settled the property yet, but between now and the property settlement, you had an accident or something goes bad, and so we always suggest the client to take the insurances now, And sometimes people, they do come back with saying, oh, it's extra expense. But when we do actually, when you look into the reality, it's not expense. It's like you insure your car, you insure your home, and you pay the premium. But the biggest assets, I believe, it's us. We are the one who's working hard to like buy the new property, buy the new house. We want to insure the house and the car, but we don't want to insure for ourselves.
Yeah.
Yeah, so that
It's crazy how it works, right?
yeah,
It's only because it's like forced. It's almost like unless someone forces it, it might not happen as much. Because car insurance, like, oh, what if something happens in the car? And it's like, oh no, my bumps and scratches and these things are more important than you. It's crazy how that
yeah, this,
works.
this is definitely a reality where people, they think about their self at the last before they want to think about the car insurance and property insurance like landlord insurance or home insurance. They never think about what happened if they can't work, or if something happened to them, and what happened with the family. Because if you got a mortgage, let's assume like you got a property, yeah, you got a young family, you insured your property, but you pass away or something happened to you and there's no income. The bank is not going to be wait for like another 1 2 years to actually start getting the repayment. They really want their money back. I always suggest my client, if you're working hard and you're making a 6 grand and you can't afford $200 premium for a month, what happen if you're not working and you have no income? How are you going to afford like 5 grand for your living and mortgage repayment? So it's like just the mindset. You need to understand what's really important to you. And I believe the risk insurance says it's really important for everyone, young or old, doesn't matter. You need as quickly as you can buy.
People go through having cars for a decade, having homes for decades, and they don't blink an eye at the cost of that. But if I'm not mistaken, with some insurances on the ones you've mentioned, is there also potentially a way that financial planners can have that, depending on the scenario, come out of superannuation as well? Is that possible? Is that allowed?
It is possible. If you only insurances we recommend to buy outside the super, it's income protection, because that is tax deductible premium. So it's like you're protecting your income if something goes wrong. The trauma insurance, definitely you can't buy inside super. It's like policy doesn't allow. But life and TPD, yes, you can buy inside super. Yeah, if you can't afford the income protection outside super, you can still buy inside super, at least to protect you if something goes wrong. But the problem, not the problem, but it's just the super has different policies. So the trustee, if something goes to you and you can't work and you make the claim for the income protection, the technically money goes back to the super fund, and that's how you need to apply through the trustee of the fund to release the money. That
So
could
it's
be a
more
tricky part.
technical, more
Correct. Yeah.
policies, and no tax claimability. So, like, that's a good point. The tax claimability, like, that's already a discount on that cost as a result of that tax claimability too.
Correct. Yeah. Look, people, they sometimes they don't understand. And as I said before, I'm a tax accountant. So people, they come to me and they of course they want maximum refund every year. But when we explain them, to take their income protection outside, instead of paying, like if you pay $1,000 premium, let's say you pay $1,000 premium for your income protection, you're getting about, depend on your bracket of tax bracket, you're still getting about like 32% or 37% back premium in your pocket. So you're only putting like 67 or 60%, depend, 40%. So it's like, I'm a big fan of insurances because I have gone through all these. I understand the value of these products. So people, that when they start understanding, they definitely want to do one thing first, to buy the insurances.
Financial planners like yourself and the team, they can also assist in the event of issues, meaning like if things come up, the client can contact your team to understand how to get the help, and you're able to support that client with getting help from that insurer. Is that right? Have I understood that correctly?
Correct. So as I mentioned to you, so I've got three people that works in this area. So if someone had any incident and they really want to make the claim, we do help them to fill the application and talk to the insurance provider to actually they get their money. So yeah, we gone through some in the past, some claims, and we have seen that success rate. So people, they actually got their money back.
Yeah. No, that's really powerful. I mean, Mate, this has been a really impactful episode because it's really brought home that point of coverage and alongside that, alternate ways to build wealth. So, for everyone tuning in, just to summarize today, remember this is general advice in nature. It's not personal. And any time that you are looking for those personal discussions, reach out to Shamsher and his team. And I'll hand it over to him in a second to explain about how you can. But before I do, there's a bit of a recap here I want to share. Firstly, I am biased when I talk about property investing. At InvestorKit, we aren't financial planners. We don't do financial planning. I'll do my best to holistically say maybe you should consider other things, but at the same time, I know what I know. This is my swim lane. I'm going to go buy that other property, buy that next one. And it's important you don't take that in. You take a step back and realize, am I on that other side of 40 or 50, like Shamsher was explaining? Do I need to consider more diversification? Things that don't have debt attached to them, things that can be multiple assets in one asset, like a managed fund. And could that be another way to give me another return and having their team support me with wealth planning, not just property planning? Because that could be very important in getting you to your goal. But then, secondly, is there are different types of things out there to protect your goal of generational wealth, if that's one of them. And the last thing you want is having all this work done, having an uncontrollable factor in life hit you, and then all of a sudden you can't provide or you can't support what you'd wanted to with where you put all your efforts to build something. There's income insurances which have tax deductibility, life and TPD and trauma that can come out depending on the policy from super or without. And at the same time, you can have that suited to your situation. Obviously, I will say though, with some meaty application forms, like, they're pretty intense when you're getting insurance money back from someone. But the main thing is you'll have support from a team. I went through some personal stuff and I am having it's a blessing in disguise. I went to get life insurance, and when I went to get it, I was one of those few people that got declined for cover. And the reason was because of some underlying health issues that I needed to get checked up. And now I'm going through and working through that. But sometimes you don't even realize that, like, had I not gone through this process, I, as scary as it sounds, as crazy it sounds, in the next 5 years, I may not be here. Like, that's how crazy it is. Had I not known about these health issues. So it's crazy that not by actually having the symptoms, but by checking to protect my wealth, I learned about stuff that was wrong with me that I need to get fixed up and work on, which I'm working through. So it's crazy. Like, when you just think that everything's going great, you're building wealth, you're building businesses, you're building careers, and then something can shock you like that. So I encourage people who are tuning into this from a personal story, go get yourself checked up financially and go get yourself checked up health personally. And sometimes it takes these moments where you go and get protection, speak to teams like that to be able to go, hey, you know what? I'm now good. Or you might have my situation where you go, holy crap, I didn't know that. I better go look into this and fix this up. So it's a big blessing in disguise, even the process alone for myself. So Shamsher, a massive thank you for your time today. How can people reach out to your team to learn more about getting holistic financial planning, things like managed funds, things like protection? And of course, I'm going to have you back on another episode to talk more about some other things. But how can they get in touch with these two areas?
Look, people, they can go to our website, royalwealth.com.au, or they can call us on 5922 4353 and to book an appointment with us. We can do the Zoom meetings or face to face, depend on the location. If someone is from Sydney or Queensland, the preference definitely the Zoom meetings. And if someone locally in Victoria, then we do mostly face to face because, as I mentioned I mentioned before, we had 3 offices in Melbourne. So yeah, anyone they need help, please reach out to us through the phone call or the email address or through the website form. So we will try our best to connect with them. But I also would like to say thank you, Arjun, for some of our customers. They really gave a good feedbacks about your services as well. And yeah, thank you. Doing all this for public, I believe. You're doing a great job.
Too kind, my friend. And that's ROYALE wealth.com.au. That's the one.
Correct, yes.
Perfect. Well, mate, thank you so much. And we'll have you on for part 2, where we'll be jumping through self-managed super funds and more of that financial planning, management, cash flow, just for people to understand the budgeting and the systems and actually building a plan in another episode. Looking forward to that, my friend. And thank you again for joining on.
Yeah, thank you. Thank you so much for today. See you soon.